CEO retired, they had strong revenue streams. They got way more out of Social Security than they ever put in. So in the grand scheme of things, okay, the majority of companies were also offering pension plans. 93 out of 100 companies, 92 out of 100 companies in the Fortune 100, literally the Fortune 100 were offering defined benefit pension plans in the 80s and 90s. Today, how many companies in the Fortune 100 are still offering pension plans? 7. We're one of the 7 companies in the Fortune 100 that are still offering pension plans, which means that you didn't need a lot of savings back then because you were going to have a significant income from Social Security, a robust pension, which meant that the day you walk out of your job, they paid you, and as an example, $50,000 a year for the rest of your life, okay? And ultimately, that situation has changed significantly. Today, the reason that I'm deeply committed to the clients I work with is because I understand this dynamic, that the vast majority of my peace of mind as a retiree will not come from the government, and it will not come from my employer. It will come from my decision making early on. It will come from the fact that I work with a financial professional to be able to identify what my goals are and work diligently over the course of 10, 20, 30 years towards creating a large enough pool of money that I could use as a dependable income stream in retirement. I'm gonna need a lot of personal savings because the only person that's gonna take care of me 20, 30 years from now is the young version of that person today. And I've gotta be able to take this seriously, and from a prioritization standpoint, understand that I've gotta pay myself first. Because the clients, John, that I talk to say, I can't save another 10%, and I ask those clients, if the IRS raised your taxes by 10% overnight, what would you do? You'd complain about it, you'd groan about it, you'd moan about it, but then what would you do? You'd find a way to pay it. See, we will always adjust if it's absolutely non-negotiable, if it's necessary. What I'm asking you to do is create the standard where it's self-imposed and not imposed on you externally. All right, and as a byproduct of that, you're gonna be able to outpace the effects of inflation. You're gonna be able to outpace the effects of all of the risks that most people aren't really thinking about right now that we're gonna plan for. Now, in the second appointment, this could be the first or second depending on how long you have in the appointment, because that's gonna lead to fact-finding and you're gonna ask financial questions like, you know, I love these financial questions in the fact finder. If you don't ask these questions in the first appointment, I don't think you have an appointment, okay? What's your number one financial priority at this time? I wanna know what's on your mind. What keeps you up at night, okay? As you think about retirement, what kind of lifestyle do you envision in retirement? The next question is, what would that cost? So in today's dollars, what would you like to be spending when you're retired? With inflation, I'll have that educational conversation. The next question is, how much of that income would you like guaranteed? How much of that income, based on the tax environment we're in today and the possibility of rising taxes, would you want subject to taxes? Okay? I want none of it subject to taxes. Well, that's important because what percentage of the money that you're taking out of your largest financial asset today, your 401k, is going to be taxable? Has anybody educated you on that? No. It's 100%. 100% of the income you have from 401k, from IRA, from qualified retirement plans is going to be taxable. And so what I'd like to do is I'd like to educate you on why a lot of people use these financial tools in the 70s and 80s, is because when the 401k was created in 1973 and the IRA in 1974, we were still historically at very high tax rates. This tax chart has to be second nature for you guys, okay? When you show this tax chart, this is minimum a 10-minute conversation, okay? And I'm going to educate you, John, on the fact that in the context of tax history, because this is important to be able to know where to put your money and why. See, in 1929, stock market crash, Great Depression. Roosevelt comes in, by the way, one of our clients, he introduces the New Deal, right? Creates Social Security, welfare, creates new jobs, stimulates the economy, but it costs not the government, it costs the taxpayers the money. The highest federal tax rates explode. We had a 91% federal tax rate for over 22 years. The average taxpayer was paying, over that period of time, in 60 years in America, we have 14 tax brackets, our average taxpayer was paying 45%, more than our top 1% pay today. So back then in the 70s, at historic tax highs, it still made sense to do what? Defer. Avoid paying the 45, because every time you contribute to a qualified plan, the IRS says what?
You don't tax.
I won't tax you today at 45. I'll tax you when the money comes what? Out. So So every time you contribute to one of these plans, you're making a bet. This is an important one. You're making a bet. See, for people who contribute here, okay, you're making a bet that when you take your money out 20, 30 years from now, taxes are at least what? The same, if not preferably lower. Today, millions of Americans are doing retirement planning like their parents did because they're not getting the financial guidance of high-level tax counsel because they're still making the same bet. See, it's great to defer at 45 and pay at a post-tax 15, but is it great to invest at a pre-tax 15 and hope that 30, 40 years from now, taxes are going to be the same or lower? Because if you're going to bet that taxes for you, where are taxes today, 10, 15%, are going to be the same 20, 30, 40 years from now, or lower than they are today, I would say that's highly unlikely. But since I don't have a crystal ball, what I recommend my clients do is not put all their eggs in one what? Basket. I educate my clients to do tax diversification. Because what you don't want to have happen is have all your money coming out of a pre-tax basket 30 years from now where tax rates are significantly what? Higher than they are today. Because if you defer at 15 and hypothetically withdraw at 30, that's a financial mistake that could have a devastating impact on your quality of life in retirement. So here's what we recommend our clients do. And by the way, we offer all of this. Okay? We offer all of these products. What you've been traditionally contributing to are the products on the left side. And by the way, we offer these products. But in our 6-dimensional tax system today, what we help our clients understand is the power of the 3 statutory tax exemptions, the power of Roth assets, Roth IRAs and 401ks, the power of tax-free municipal bonds, the power of cash value life insurance. If you have family, you want to kill 2 birds with 1 stone, you can maximize these benefits. Let me explain this to you in a way that's simple. You get to invest your money today, the money in your bank account. You get to tax defer all of that money without ever paying any taxes on the gains. And if it's structured properly, you get to take income from all of those gains without ever paying the IRS. You never report it. Okay? We know how with Roths, we know less with tax-free munis. We'll talk about that today. But with cash value life insurance, there's a huge loophole in the tax code under section 7702. Write that number down. Section 7702. What are all the banks doing right now? What are they looking at? They're all looking at private placement life insurance. They're looking at PPLI. There was another article over the weekend on this, where JP Morgan is spending more, billions and billions of dollars, putting more PPLI, okay, on the balance sheet of their banks. But most clients who do private placement life insurance and banks have to invest $2-3 million. Do your clients have to have a $2 million minimum to start a whole life policy with us? No. So guess what? I'd like to give you the pros and cons of each of these so that you make the most appropriate decision for your family. So I go through the pros and cons of the Roth, okay? The fact is, you get the tax-free distribution, but you have some income limits. And you get the cost basis as liquidity for emergencies. With the cash value life insurance, you get the waiver of premium. If you got disabled, we would pay it for you. If you needed long-term care services, we can add a provision in the policy that says we would take care of you. It's self-completing. You have a legacy benefit. You have the liquidity. It's a personal bank account. You have the guaranteed cash value growth. You have the chronic illness rider. You have the terminal illness protection. So I don't have time this morning to go through all these, but I'll talk about it. But what are the downsides? I have to qualify. I have to qualify from a health point of view. There's not going to be a lot of cash value early on. There's an acquisition cost for the legacy benefit. Then you have municipal bonds. So I go through the nature of inverse relationship of interest rates and the value of bonds. We sold a lot of munis, John, in the last 10, 15 years because interest rates post-recession were relatively what? High or low? Which did a lot for us when we were buying high yield bonds, when we were buying safe bonds, it was a great market for it. But today, as interest rates begin to scale higher and with an inverse relationship with bond values, what happens to the value of my bond if interest rates go up? Does it get up or down? It comes down. Now, we hedge in our municipal portfolio. I could offer you some options there, but I cannot eliminate the cons, the downsides, which are what? Default risk, interest rate risk, and if you buy an individual bond, not a fund, there will be taxes due if you sell it at a premium, which is not a bad problem to have, but you should consider these. Then I draw it out, okay, before I ask questions, okay? Because most people are not like all warm and fuzzy about this. Most people will probably look at this in the middle market. In the affluent market, they'll be here. Keep this in mind. Middle market, they're where? Here. Affluent market, here. So I draw it out. I say, this is how a Roth works. If you put in, this is your contribution over an extended period of time. What happens is, this is how your account looks over an extended period of time. It's a defined contribution plan. So the income that I take out, can I get a statement from T. Rowe Price or New York Life that says, this is your guaranteed income portion when you retire on every contribution that I make today, yes or no? So what's my income stream here? And I draw a question mark, okay? What does it mean for money to go up and down, for your balance to go? It's called what? Now we could minimize and regulate the volatility by doing what? Diversification, and the other thing is asset allocation, but could we eliminate it? Unless we go to cash, I can't eliminate your volatility, okay? But here's what we can do, and I apologize for the people sitting there, okay? Here's what we can do. If you want to kill two birds with one stone, you have a family that you want to protect, kids, mortgage, spouse, da-da-da-da. It's funny how he said spouse last, but that's not intentional. But, okay, you have another opportunity that looks like this. Early on, if you put in $10,000 a year, here's what's going to happen. You have a guaranteed level premium and cost of insurance. Your cost of insurance will never go up. You could accumulate a pool of money where you can use about $1 million of it income tax free without ever reporting it to the IRS. And even after you pull out $1 million in retirement, you're going to have a legacy benefit at life expectancy of about $400,000 that refunds your beneficiaries the $300,000 you contributed for retirement income tax free. So said another way, I put in $300,000, I use $1 million without ever reporting it, and at life expectancy, New York Life will refund my beneficiaries $400,000, and how much of that is taxable? Nothing. And along the way, I get waiver of premium, I get chronic illness rider, I get, which means, and this is important because, fall in love with these words, which means, and this is important because here's the thing, your clients don't know what you're talking about. You've been through 1,000 hours of training and you still probably don't know what I'm talking about, okay? You have, some of you, most of you do. But that's, keep it simple, straightforward, digestible. So when you educate the clients on the pros and cons, what's the next conversation? The next conversation is keep it simple. An example, a concrete example of this is that if you don't diversify and you take out $100,000 from a 401k, you pay your 25%, you net $75,000. If you take half of it from your 401k, now you've lowered your overall tax bracket because, again, in our 6-dimensional tax system, the less I take in our progressive tax system, the lower my what? Bracket, the less my tax. I take the rest of it from the cash value life insurance at $50,000, I end up with $92,000 versus $75,000. It's bad enough to have $75,000 versus $92,500. You know what's even worse? Having set aside the same amount of money that the guy did that had $92,500. So our computers, our software, our process helps you make the right contributions in the right places so that you can optimize the income in retirement without having to take a disproportionate amount of what? Risk. So that you can hedge the future shortfalls. Because if taxes go up, I can take more money from the taxable or non-taxed asset. Non-tax early and be able to time the distributions. Did you know if you bought a Roth IRA or took income from municipal bonds in retirement, your Social Security income plus the Roth and the municipal bond income, that it would add to your taxable bracket? That the income from your Roth and the income from your munis actually adds to your taxable income when you retire? Who knew that? Who knew that? Few hands. What's the only Roth asset that doesn't count towards your Social Security tax calculation? 7702. That's the only thing. 7702 is the only tax exemption that doesn't compound your Social Security tax formula. The income from a Roth does, the income from munis does. So I just want you guys to have the swag out there, because this is what banks are doing, okay? This is what people should be doing, who need to have the dependability, but people need to know why they're doing it. Here's why. Here's why. If they don't understand it, and they wake up the next morning, and they're contributing thousands of dollars into a product they don't understand for a problem they don't think exists, what are the chances that that policy is going to stay on the books 5 years from now? Okay? And I've done a disservice if it doesn't. So the reality is, wait for it. You guys probably all want to know, how do you close? That's great, you teed it up, you gave context, you gave reasons. How do you close? You know how I close? Ask questions. Here's how I close. 3 questions. Okay? This is going to be a breakthrough, okay? Question number 1. Does this make sense? Okay? So I go through the pros and cons. John, does this make sense? That's closed question number 1. What's closed question number 2 in no particular order? What are your thoughts about these options? I know it's aggressive, right? Total salesperson, okay? You did this, you're a consultant, all right? Question number 3. Which one looks most appealing? That's it. Let the client dictate where they go with this. John, based on the time we've spent together, my professional recommendation would be that you allocate X into a Roth asset to have the most tax-efficient vehicle for retirement. You do need $2.5 million of coverage. We could do that in either temporary term, it's like renting, or we could do that in permanent, okay, life insurance, which is like owning, building equity. Ultimately, the choice is yours, and then I go through, does this make sense? Which one looks most appealing? What are your thoughts about these options? Then, if they go with the life insurance, which if you do this talk right 9 out of 10 times they will, okay? What you ask them then is, now they want it, what do? What do you do when someone wants it? Take it away. Here's what you do. They say, I want the life insurance. You say, all right, but you've got to qualify for it, as I said before. We've got to make sure that you look as good on the inside as you do on the outside. What that means is they're going to look at your medical records, they're going to look at your, okay, do you have any reason why, health-wise, you wouldn't qualify for this? Now I'm, what? I'm pushing. What was I doing? I was pulling, now I'm doing pushing. So I'm asking them, do you take medication? Have you ever been diagnosed with something? Do you visit your doctor? Do you have high cholesterol? I ask the questions, guys. Ask the questions and say, look, best case scenario, I'll try my best to get this issue. Worst case, we'll look at another Roth asset. No, but I really want that. It comes with all the other stuff you talked about. Look, I can't work magic. We're a mutual company. We have to protect our policyholders. Once you become a policyholder, we'll protect you too. Okay? But right now, we have to make sure that you are healthy enough for this, and we'll go from there. That being said, please cooperate with the people that call. I might ask you for financial information. I might ask you. Now, if I don't promise you a rating and I go back with a non-smoker, do I have to apologize to you? No, because at non-smoker, the value is still unbelievable. At standard, the value still. At standard 4, the value still. Because we can always go back and do what? Re-rate the policy. If your health improves, we could always go back and re-rate the policy. What's the best underwriting period in New York Life on the calendar or fiscal year? What month is the best underwriting period? June is the best underwriting period. Number 2, December. But June is the best underwriting period, so I say, look, this is the month to do it. Okay, and if you are concerned about the cholesterol medication, the high blood pressure medication, this is the month to do it, okay? And so let's make sure that we do that. Now, you've got to get cash for that, because you're not going to be able to go back and pay these unless you know, on a short timeline. So we've got to bind the coverage. I would take premium at non-smoker. So what I tell the client is, look, what we do is we bind the coverage. So when I walk out today, okay, and underwrite this plan, the deposit you provided will cover you throughout the underwriting process. This is important because the goal in underwriting will be to get this plan issued, and when we get together, we'll review everything again to make sure that we're on the same page. Okay, if any adjustments need to be made, we could do that because we want you guys to be comfortable with the funding and the duration. We want this to be an empowering process and one that really helps you guys pace the changes out there. Okay, and I'm going to meet with you and update this planning station financial plan to make sure that you are reaching the type of goal and the quality of life that you deserve. So by updating your plan over time, we can keep you ahead of the shifts that are happening out there. Okay? And that's why they should be doing business with you, and that's why they should be doing business with New York